In a world that is looking for alternative investment destinations, Africa is seen as the next investment and growth frontier. However, in order for the continent to secure its place in the global economy, properly developed infrastructure that can support business development across the continent needs to be established. Let's take a look.
Africa is well positioned as an emerging market and is a wealth of opportunity for investment and growth. The world is eager to do business with Africa, however finds it difficult to access the African market, especially in the interior, primarily due to poor infrastructure. Although the continent has successfully maintained an average growth rate between 4 to 6% in the past few years, Africa accounts for 12% of the world population, but only generates 1% of global GDP and only 2% of world trade.
The individual country borders into some of the big regional integration programs that are on the cards, like SADC, COMESA, East African Community, then we see that the numbers are there to support the scale. 600 to 700 million people, $1 trillion combined GDP, literally from Cape to Cairo, a large area as well. And I think that this is a base that we can build on.
Energy supply continues to be Africa's largest infrastructure challenge, with 30 countries experiencing frequent power shortages, and with only just over a third of Africa's population with access to electricity. Electricity supply is among some of the business opportunities that can power Africa's growth. In a recent study, it was shown that the poor state of infrastructure across all sectors reduces national economic growth by 2 percentage points each year and cuts business productivity by as much as 40%. The high costs of business have had a ripple effect on businesses and consumers alike.
There's definitely benefits for trade in the continent in terms of especially freight rails, various plans to grow its rail infrastructure in the coming years. So those were very welcome commitments. Those have been a source of complaint and concern of our members for a long time, that we are inefficient in moving goods to our harbors and getting them to the rest of the world. So it doesn't help Africa in particular right now, but they're definitely going to be spin-offs.
Although investing in infrastructure is paramount, approving the right type of infrastructure at the right time is just as crucial to a continent's continued economic development. But these capital outlays do come with a price tag. According to the World Bank, $90 billion is needed in order to fund infrastructure for the next 10 years. $60 billion will go to new projects and $30 will go to the maintenance of the existing ones. However, only $25 billion has been allocated for these capital outlays. With Africa having received its largest share of global foreign direct investment to date in 2011, this may very well help fill the financing gap.
Now joining me in studio to give us their thoughts on infrastructure in Africa, Emile du Toit, Head of Infrastructure Investments, Harith Partners, Paul Runge, the Managing Director, Africa Project Access, and Brian Blake, Vice Chairman, Marsh Africa, and of course joining us from our bureau in Nairobi is Gabriel Negatu. He's Regional Director of the AfDB's Eastern Africa Resource Centre. Gentlemen, thank you very much for your time. How are we going to close? Let's start with this coming out of that introduction. How are we going to close the infrastructure gap, that much talked about infrastructure gap that could in fact increase economic growth across the continent by some 2%?
Thanks, Bronwyn. I think the gap is quite big, clearly, and a lot of investments required. I think investment from all parties, both public and private, is required. And that's one of the things that we're seeing, is that governments are realizing more and more that they can't fund this off their own balance sheets. And we're seeing increasingly use of PPP models. And that's really the space that a fund like ourselves also look at investing in. So it's essentially necessary for both private and public sector to invest. And for example, one of the areas where we source our funding from is from local pension funds. And I think what you need to see going forward as well is more African pension funds investing into Africa, as opposed to taking their investment money and buying US bonds and things like that.
Paul, do you think that's a reality? We are going to see more African pension funds investing in Africa?
There will be the need to mobilize local finance is a very big issue. And within the project finance space, the number of players now in this market has increased considerably. We're talking about it's not business as usual anymore. We're talking about operators funding their own projects. For example, Vale and Zambezi Valley They are part of the Nakala Development Corridor Group. So much of what's going on is resource driven in the end. And the infrastructure has to support the resources and evacuate and export the coal, for example, from Zambezi, from Botswana, et cetera, So it's created a very strong impetus for support infrastructure development at the moment. And I think what's happening now with support, with finance for projects, is that the sources of the finance have widened considerably. So, for example, operator finance. But there's sovereign wealth funds, there's equity funds, there's numerous equity funds that are appearing all the time.
There's no doubt it is a hotspot for investment. Brian, let's get your thoughts on this.
Well, I think from my point of view, and this is slightly self-interested here, our view is that you need to make the lenders more comfortable. You know, a PPP can last in excess of 25 years. The finance for the project is at risk from day one, from the start of the project. And our work essentially looks at how to identify, how to mitigate, how to transfer the risk associated with the projects. And if you look at projects north of South Africa, you have certain generic risk associated with political issues, regime change, convertibility of currency, ability to remit funds abroad, the security that protects the financing around the asset. So a lot of our work really is around the whole life cycle of the risk, from the conception of the project through until the execution and maintenance and operation and beyond. And then look at it from the point of view of the different parties in that structure, whether it's the lenders, whether it's the construction companies, whether it's the professional surveyors or engineers. Everyone is going to cost that risk, the finance risk.
Gabriel, perhaps we just pick up on what Brian has said there. It's about making the lenders more comfortable. Do you think that is the reality? Is that what is happening on the ground?
Well, absolutely. I agree with the previous presenter. The need to make the lender more comfortable is indeed an issue, and this borders on the issue of governance, on the issues of capacity. And we at the African Development Bank, in addition to the financing we provide, do work with government to help them set up the appropriate regulatory and policy framework to encourage PPPs, to encourage greater governance, transparency and accountability, again, to give comfort to would-be investors to come and join the public sector in financing infrastructure.
Emile, do the risks outweigh the rewards still to this point?
Thanks, Bronwyn. Yes, I think there's a fair balance to be had. Essentially, what we're seeing is that that in order to mitigate all these risks, as Brian has clearly said, it's quite complicated, and that all adds to the cost of the project. And so project financing costs in Africa clearly is quite high, much higher than you would find in more developed areas. As an example, you would need to have lawyers coming in from different areas. Also, just the logistical problem around that does increase the cost. And so the question is always, for the perceived higher risk, you're supposed to get a higher return. But I think the project cost and the additional project cost that's added by the structuring reduces that. So, in some cases it's difficult to get that, and that's really where the private sector gets involved at trying to pick the projects where the risk reward does make sense, and the ones where it doesn't, maybe engage further with DFRs or local governments to try and improve that situation.
Can I just put a twist on this a little bit? We're talking a lot about the government, the regulatory environment, and that is very important, no doubt. But talking more from the actual operator's side, where I come from, I'm more involved with project identification, and I work a lot with individual companies and contractors and so on. There is a huge need at the moment for companies to react in the right ways in order to mitigate risk and so on. One thing is to develop consortia that make sense. And that is happening. There's more and more collaboration, cross-border as well. I mean, cross-nationality consortia building that is happening, and it is assisting. But the other thing that is very frustrating is that certainly in the case of South African companies, I realize we're not just wearing a South African hat here by any means, but as South Africa is perceived as a major player, the lack of utilization of the financial instruments that they have at their disposal is a big problem. South Africa has the Development Bank of Southern Africa, has the Industrial Development Corporation, has the Export Credit Insurance Corporation. If you do a survey of many of the players, they are not, I'm generalizing.
So you're saying that the financial institutions are there, but people aren't using them?
Exactly. Certainly in the South African case. Of course, I'm generalizing. There are people who are using them. But I would say that, for example, the Capital Project Feasibility Fund is one of the instruments offered, products offered by the Department of Trade and Industry. Yet its utilization is very poor. And if you do a survey, you'll find that very few people are aware of this. So there's a bit of a disconnect between the operators and the financial people.
What do you think about that, Gabriel? Is there a disconnect between the operators and the financial institutions or the financial instruments available out there?
I'm not sure I have the data on South African firms in particular, but for the African Development Bank, the resources that we have made available are utilized quite extensively. And of course, you have to bear in mind that we ourselves directly finance infrastructure projects through the public sector, both through loans and grants. And then we have the private sector window, which syndicates loans to private operators and makes available resources. And so far, we have not had much difficulty finding takers. But as the colleague said, we've got DBSA in South Africa, and then the other institutions. There may not be as many takers as I would have otherwise guessed.
Brian, let's get your thoughts on this.
You know, we've seen over the... I've actually been in Africa now for about 30 years, and it's interesting the way that these projects have been viewed and developed over the years. I believe in the past they've been very hit and miss, and in some of the projects I've seen they were more miss than hit. Certainly I remember when I first went to Nigeria there were great plans for a railway going around Lagos, a high-speed railway going around Lagos. Now if anyone's ever been around Lagos you know that high speed actually can mean anything above 5 kilometers an hour. But this thing was ill-conceived, ill-planned, and there was, as we just said, a lack of governance, a lack of control. It wasn't just Nigeria. These things happened everywhere, and you found a lot of the financing disappeared before it actually got anywhere near the project. I think that going forward now, there's more certainty around the way that financing is being done and the vehicles that are being used for the financing. You know, PPP is a generic term that tends to be used for any public-private partnership. But I think that we just need to, there needs to be an encouragement of the participation of the different sorts of finance available in the different projects that are coming on.